And Wednesday the 3rd was the day we've all been waiting for, Fed Day. Quite the open on the markets. MBS were up 33 basis points. The 10-year was down only 3, which is kind of small compared to the 33 basis points. Stocks were up 8. Bonds were unchanged for the first half of the overnight session, largely because they were not trading in Asia due to holiday closures. Futures still trade, but they were flat, as is often the case when the cash market is closed. Things picked up at the start of the European trading with Bunds, love that word, leading treasuries several basis points lower from 3.44 to 3.39. The 8:15 a.m. data caused a brief jump back above 3.42, but they're already back down to 3.40, holding a 3 basis point gain on the day. ADP payrolls came in at 296,000 versus a 148,000 forecasted, huge raise. Private payrolls rose 296,000 last month following a revised 142,000 increase in March, according to figures published by ADP. The figure exceeded all forecasts in a Bloomberg survey by economists and was nearly double the predicted median number. Hiring was led by leisure and hospitality, has been the case for a long time. Education and health services and construction also added to the gains. Companies in manufacturing and financial activities cut jobs. Firms of all sizes boosted headcount. We also got the ISM non-manufacturing data. Came in at 51.9 on a 51.8 forecast. It was 51.2 previously. And then we got the Fed news. A whole bunch of different stuff here that you can see on the screen. Fed raised the benchmark rate 25 basis points to 5 to 5.25 range. It omitted language that was in prior statements that signaled more rate hikes ahead. They didn't say there weren't any hikes coming. They just admitted the stuff saying that there were more to come. It did say that inflation remained elevated, highly attentive to inflation risk. It also says tighter credit conditions likely to weigh on activity, and it was unanimous. There was really only one option for the Fed today, which was the 25 basis point hike, but the signal, the willingness to let that be the ceiling, that's essentially what the Fed delivered, both in its announcement itself and again multiple times in the press conference. In addition, Powell didn't express much concern about the banking sector other than to say that it implies credit tightening. He also reminded us that Fed economists are still forecasting a mild recession later this year. Let's say that again. He also reminded us that Fed economists are forecasting a mild recession later this year. All the above is about as good as the bond market could have hoped for today. Bond market liked this Fed news. At the end of the day, we were up 27 basis points, which was actually down from the highs on the day. 10-year actually kind of caught back up, being down 6 basis points, but stocks lost 36 points. So at 100.91, that puts us in this big wide range right above the 200-day moving average, which is the light blue line. So we have a real wide range. So if we stay in that range, it could be bouncy the next couple of days. We also got some interesting stuff this morning. Larry Summers was interviewed by Bloomberg TV yesterday, and the interviewer asked him about reports that up to half of U.S. banks could have negative equity if everything was marked to market. I haven't seen such reports, but it's a remarkable statistic if it's true. Larry's answer didn't really push back against that claim. However, he called it somewhat alarmist because it didn't take into account that many banks have deposit rates below the interest rate earned on these treasuries in U.S. and MBS. So they're earning a spread that below market rate deposits would be considered asset-like. So basically, it's ignoring the fact that they're borrowing money at 2% and it's invested at treasuries at 4%, making that 2% spread. But if you have to update those to market, it creates paper losses, which freaks everybody out, but they're actually still making money.